The most dangerous words in finance aren't market crash or bear market. They're smart borrowing and good debt. These phrases sound sophisticated, but they're usually euphemisms for financial suicide disguised as strategy. Leverage is mathematics, not magic. It amplifies everything: intelligence and stupidity, patience and greed, success and failure. Most people who use leverage think it will only amplify the good parts. They're always wrong, and the market always collects. The greatest fortunes in history were built without leverage. The greatest disasters were caused by it. But human nature prefers the stories where leverage creates miracles, not the stories where it creates bankruptcy. Every generation rediscovers leverage as if it's a new invention. Every generation learns the same lesson. Borrowed money doesn't just multiply your returns, it multiplies your mistakes, and mistakes compounded at high speed destroy wealth faster than success can build it. Let me tell you about Richard Castellano, a man who built a real estate empire through smart borrowing and lost everything because he confused intelligence with invincibility. The smart borrower. Richard Castellano graduated from Wharton in 1995 with an MBA in finance and what he considered a sophisticated understanding of leverage and risk management. Unlike his classmates who pursued careers in investment banking or consulting, Richard was drawn to real estate because he believed it offered the best combination of leverage opportunity and downside protection. Real estate seemed like the perfect asset class for intelligent borrowing. Properties provided tangible collateral, generated rental income, and historically appreciated over time. Unlike stocks or bonds, real estate couldn't disappear overnight. Unlike businesses, real estate didn't depend on management execution or competitive dynamics. Richard's thesis was compelling. Real estate markets were inefficient, especially in secondary markets where institutional investors didn't operate. With superior analysis and intelligent financing, an individual investor could generate extraordinary returns while maintaining reasonable risk. Richard started small in 1996, purchasing a duplex in an up-and-coming neighborhood using a conventional mortgage with 20% down. The property generated positive cash flow immediately and appreciated 15% in the first year. Richard had invested $40,000 and earned $25,000 in combined rental income and appreciation. This 62% return validated Richard's belief that real estate offered exceptional opportunities for leverage-enhanced returns. If he could consistently identify undervalued properties and finance them intelligently, he could build substantial wealth much faster than through traditional investing. Richard's second purchase demonstrated the power of compound leverage. Using the equity from his first property as collateral, Richard obtained a home equity line of credit that provided the down payment for a second property. This allowed Richard to control $400,000 worth of real estate with his original $40,000 investment. Both properties appreciated rapidly during the late 1990s real estate boom. Richard's total equity grew from $40,000 in 3 years, representing a 375% return on his original investment. Richard was generating these returns while working full-time as a financial analyst, spending only weekends managing his properties. The success was intoxicating. Richard felt like he had discovered a machine that converted time and intelligence into wealth at extraordinary rates. Real estate investing with leverage wasn't just profitable. It was the closest thing to guaranteed money that Richard had ever encountered. Richard decided to scale his operation. The scaling strategy. By 2000, Richard had accumulated enough equity and lending relationships to implement what he called systematic wealth creation through strategic leverage. His strategy involved identifying undervalued properties, purchasing them with maximum available financing, improving them to increase value and rental income, then refinancing to extract equity for additional purchases. This strategy required sophisticated financial engineering. Richard worked with multiple lenders to maximize his borrowing capacity. He used conventional mortgages, hard money loans, seller financing, and private investor partnerships to fund his acquisitions. He structured his purchases through limited liability companies to protect his personal assets and enable more creative financing arrangements. Richard's operation became increasingly complex and efficient. He developed systematic processes for property evaluation, renovation management, tenant screening, and portfolio optimization. He hired contractors, property managers, and bookkeepers to handle operational details while he focused on acquisitions and financing. The results were spectacular. Between 2000 and 2005, Richard's real estate portfolio grew from 5 properties worth approximately $800,000 to 47 properties worth approximately $15 million. His net equity grew from $200,000 to approximately $4.5 million. Richard was generating returns that made stock market investing seem conservative and slow. His average annual return exceeded 35% during a period when the S&P 500 averaged less than 5%. Richard felt validated in his decision to focus on real estate rather than traditional investments. More importantly, Richard's success was sustainable and scalable. Unlike dot-com entrepreneurs whose wealth existed only on paper, Richard owned tangible assets that generated steady cash flow. Unlike stock market investors who depended on market sentiment, Richard's returns came from fundamental value creation through property improvement and efficient financing. Richard began teaching real estate seminars and writing about leverage strategies. He developed a following among investors who wanted to replicate his success. Richard's story became a case study in intelligent wealth creation through strategic borrowing. But Richard had made a fundamental error that would eventually destroy everything he had built. He had confused a bull market with personal genius, favorable conditions with superior strategy, and temporary success with permanent principles. To leverage mathematics. Richard's success was real, but his understanding of why he was successful was flawed. Richard attributed his returns to superior analysis, intelligent borrowing, and systematic execution. These factors contributed to his success, but they weren't the primary drivers. Richard's extraordinary returns were primarily due to 3 factors he didn't control: declining interest rates, relaxing lending standards, and appreciating real estate prices. These macroeconomic conditions made leverage profitable for almost anyone who used it, regardless of their intelligence or skill. Declining interest rates reduced Richard's borrowing costs while increasing property values through capitalization rate compression. Relaxing lending standards enabled Richard to obtain financing that wouldn't have been available in normal markets. Appreciating real estate prices covered mistakes in property selection and renovation management. Richard was benefiting from what economists call the leverage cycle, a period when increasing asset prices enable increasing borrowing, which enables increasing asset purchases, which drives further price appreciation. This cycle creates the illusion that leverage is safe because rising asset values always exceed borrowing costs. But leverage cycles are temporary and self-reversing. Eventually, asset prices reach levels that can't be supported by underlying economics. Lending standards tighten, interest rates rise, the cycle reverses, and leverage becomes destructive rather than beneficial. Richard's leverage mathematics looked brilliant during the bull market. Total property value, $15 million. Total debt, $10.5 million. Net equity, $4.5 million. Return on equity, 35% annually. But these mathematics were catastrophic if property values declined significantly. If property values declined 30%, total property value, $10.5 million. Total debt, $10.5 million. Net equity, $0. If property values decline 40%, total property value, $9 million. Total debt, $10.5 million. Net equity, $1.5 million. Bankruptcy. Richard's 70% loan-to-value ratio seemed conservative, but it left no margin for significant price declines. Richard had optimized his capital structure for a rising market while creating vulnerability to any substantial decline. The overconfidence trap. Richard's 5 years of success had created dangerous overconfidence about his ability to manage leverage safely. Each successful acquisition reinforced Richard's belief that he understood real estate markets better than other investors. Richard began to view temporary setbacks as opportunities rather than warnings. When vacancy rates increased in 2005, Richard saw opportunities to acquire properties from distressed sellers. When lending standards tightened slightly, Richard developed more creative financing arrangements to maintain his acquisition pace. Richard interpreted every challenge as validation of his superior sophistication rather than as signals that market conditions might be changing. This overconfidence prevented Richard from recognizing that his success had been largely due to favorable market conditions rather than personal skill. Richard also developed what psychologists call leverage addiction, the belief that more borrowing would always generate higher returns. Each successful leveraged acquisition made Richard more confident about using leverage for future deals. By 2006, Richard was using leverage ratios that would have seemed reckless in 2000. He was purchasing properties with as little as 5% down payment, using exotic financing arrangements and cross-collateralizing properties to maximize his borrowing capacity. Richard justified these increasingly aggressive strategies by pointing to his track record. He had successfully managed 47 leveraged acquisitions over 10 years. He understood real estate markets, borrowing strategies, and risk management better than most professional investors. What Richard didn't understand was that his track record was the result of favorable market conditions, not superior skill. Richard had never experienced adverse conditions, so he had no idea how his strategies would perform when conditions changed. The warning signs throughout 2006 and early 2007, multiple warning signs suggested that real estate markets were reaching unsustainable levels. Property prices in Richard's markets were appreciating faster than rental income growth. Lending standards were deteriorating rapidly. Speculative activity was increasing. Richard noticed these trends, but interpreted them as temporary market inefficiencies that would create opportunities for sophisticated investors. Richard believed that his superior analysis and financing capabilities would enable him to profit regardless of general market conditions. When several real estate experts predicted a market correction, Richard dismissed their warnings as pessimism from people who didn't understand modern real estate finance. Richard believed that traditional rules about leverage and risk had been superseded by new financial innovations. Richard's confidence was reinforced by his professional network. Other real estate investors were pursuing similar strategies and achieving similar results. Richard's lending relationships remained strong, with banks eager to finance his acquisitions. Property values in his markets continued appreciating through 2007. Richard used the continuing appreciation to refinance several properties and extract additional equity for new acquisitions. By early 2008, Richard's portfolio consisted of 52 properties worth approximately $18 million, financed with $14.5 million debt and debt. Richard's net equity had grown to $3.5 million, but his leverage ratio had increased to over 80%. Richard's portfolio generated positive cash flow, but the margin above debt service had shrunk significantly due to rising interest rates and increasing vacancy rates. Richard was optimized for a scenario where property values continued appreciating and rental markets remained strong. He was completely unprepared for what was about to happen. The market collapse. The subprime mortgage crisis that began in 2007 triggered the most severe real estate collapse since the Great Depression. Property values in Richard's markets declined 45% between 2008 and 2010. Rental demand disappeared as unemployment soared. Credit markets froze, making refinancing impossible. Richard's leverage mathematics, which had seemed conservative during rising markets, became catastrophic during the collapse. 2008 portfolio value, $18 million. 2010 portfolio value, $10 million. Outstanding debt, $14.5 million. Net equity, $4.5 million. Richard was $4.5 million underwater on properties that were generating negative cash flow due to vacancies and declining rents. Richard owed more money than his properties were worth, and the properties weren't generating sufficient income to service their debt. Richard's sophisticated financing arrangements became liabilities rather than assets. Variable rate loans reset to higher payments. Balloon payments came due without refinancing options available. Cross-collateralized properties meant that problems with one property affected the entire portfolio. Richard attempted to manage through the crisis by selling properties, but there were no buyers at any price that would satisfy his mortgage obligations. Richard tried to refinance with different lenders, but his negative equity position made new financing impossible. Richard's rental income declined as tenants lost jobs and vacated properties. The properties that remained occupied often couldn't cover their mortgage payments, property taxes, and maintenance costs. Richard was losing money every month while watching his net worth disappear. By 2009, Richard was facing foreclosure proceedings on multiple properties. His personal guarantees on business loans exposed his personal assets to creditors. Richard's credit rating was destroyed, eliminating his access to any form of borrowing. Richard filed for bankruptcy in 2010, liquidating his entire real estate portfolio at prices that covered less than 60% of his outstanding debt obligations. Richard emerged from bankruptcy with no assets, substantial tax liabilities from canceled debt, and ruined credit that would take years to repair. Richard had lost everything: his portfolio, his equity, his income, and his financial future. 15 years of wealth building had been wiped out in less than 3 years. The mathematical autopsy: Richard's collapse wasn't due to bad luck, poor timing, or unforeseeable circumstances. It was the mathematical inevitability of excessive leverage meeting adverse market conditions. Richard's strategy worked brilliantly when conditions were favorable, but failed catastrophically when conditions changed. This asymmetric risk profile is inherent to leverage: unlimited upside during good times, bankruptcy during bad times. Richard had optimized for the best-case scenario while ignoring worst-case possibilities. His 80% leverage ratio left no margin for error when property values declined beyond his expectations. The same leverage that had amplified Richard's gains during the bull market amplified his losses during the bear market. Richard's 35% annual returns during rising markets became 100% losses when markets collapsed. Richard's mistake wasn't using leverage, it was using too much leverage without adequate protection against adverse scenarios. Richard had confused smart borrowing with safe borrowing, never recognizing that these concepts are contradictory. The conservative contrast: while Richard was building and losing his leveraged empire, his business school classmate David Wong was pursuing a completely different wealth-building strategy based on avoiding debt rather than embracing it. David had started with the same capital as Richard, but chose to build wealth through equity investments and modest real estate holdings purchased with substantial down payments. David avoided leverage completely, viewing debt as a risk amplifier rather than a return accelerator. David's approach seemed conservative and slow compared to Richard's aggressive growth strategy. Between 2000 and 2007, David's net worth grew from $50,000 to approximately $800,000, representing strong but unspectacular returns. Richard had mocked David's conservative approach during their annual reunions, arguing that David was wasting opportunities by avoiding intelligent leverage. Richard's net worth was growing 5 times faster than David's during the bull market. But David's conservative strategy proved superior when markets collapsed. David's diversified portfolio of stocks and unleveraged real estate declined approximately 35% during the crisis, but he retained positive net worth and continued receiving dividend income. More importantly, David's lack of leverage meant he had no forced selling pressure during the crisis. David could hold his investments through the cycle and benefit from the eventual recovery. David actually purchased additional assets during the crisis when prices were depressed. By 2015, David's net worth had recovered to approximately $1.2 million, while Richard was still rebuilding his finances from bankruptcy. David's slow and steady approach had dramatically outperformed Richard's leverage-enhanced strategy over the complete market cycle. The psychology of leverage: Richard's attraction to leverage reflected several psychological biases that affect intelligent people when they encounter strategies that can accelerate wealth building. First, leverage provides immediate gratification for long-term goals. Building wealth normally requires decades of patient accumulation. Leverage offers the possibility of achieving wealth faster through borrowed money. This immediate acceleration is psychologically appealing because it reduces the time between current sacrifice and future reward. Richard could see meaningful wealth accumulation within years rather than decades. Second, successful leverage use creates overconfidence about the strategy's safety. Each profitable leveraged investment reinforced Richard's belief that he had mastered risk management. But success with leverage during favorable conditions doesn't validate the strategy's safety during adverse conditions. Richard's track record was the result of timing rather than skill. Third, leverage feels intelligent because it requires sophisticated analysis. Richard enjoyed the complexity of structuring financing arrangements, analyzing cash flows, and optimizing capital structures. This intellectual sophistication made leverage feel like smart strategy rather than speculation. But sophistication doesn't eliminate risk. It often obscures risk by making dangerous strategies feel safe through complex analysis. Fourth, leverage addiction develops gradually through successful experiences. Richard started with conservative leverage and gradually increased his risk exposure as his confidence grew. This gradual escalation prevented Richard from recognizing when his strategy had become dangerously aggressive. Each incremental increase in leverage felt like a logical extension of his proven approach. The modern relevance. Richard's story has become more relevant rather than less relevant since the 2008 financial crisis. Low interest rates and aggressive monetary policy have created new leverage opportunities that attract intelligent investors seeking higher returns. Modern leverage takes different forms than Richard's real estate strategy: margin lending, option strategies, currency borrowing, cryptocurrency loans, but the underlying mathematics and psychology remain unchanged. Today's leverage advocates use the same arguments Richard used: sophisticated analysis, intelligent risk management, and favorable market conditions make borrowing safe for educated investors. These arguments are as dangerous now as they were in Richard's era. The financial media continues celebrating leverage success stories while ignoring leverage failure stories. This creates survivorship bias where people see only the winners and assume leverage is generally safe for intelligent investors. The wealth building principles. Richard's collapse illustrates several crucial principles about leverage and wealth building. First, leverage amplifies everything, not just returns. Richard focused on leverage's ability to increase his gains, but ignored its ability to increase his losses. Leverage is a risk amplifier that affects all outcomes proportionally. Second, favorable conditions don't validate risky strategies. Richard's success during the bull market didn't prove that his leverage strategy was safe. It proved that bull markets make many strategies appear safer than they are. Third, complex analysis doesn't eliminate fundamental risks. Richard's sophisticated financial engineering made his strategy feel intelligent, but didn't change the basic mathematics of leverage during adverse conditions. Fourth, gradual risk escalation is more dangerous than obvious risk-taking. Richard's incremental increases in leverage prevented him from recognizing when his strategy had become dangerous. Fifth, forced selling during adverse conditions destroys long-term wealth. Richard's leverage created obligations that forced him to sell assets during the worst possible market conditions. The character lesson: the difference between Richard and David wasn't intelligence, education, or opportunity. It was character, specifically the character trait of accepting moderate returns rather than reaching for exceptional ones. Richard possessed the intelligence necessary for wealth building, but lacked the character necessary to build wealth safely. His desire for accelerated returns led him to accept risks that eventually destroyed his wealth. David possessed both the intelligence and character necessary for wealth building. His willingness to accept moderate returns enabled him to avoid risks that would have threatened his long-term financial security. Character matters more than intelligence in leverage decisions, because leverage appeals to intelligent people who want to accelerate their financial progress. Intelligence enables people to rationalize dangerous strategies through sophisticated analysis. The fundamental choice. Richard's story illustrates the fundamental choice that every investor faces between safety and speed in wealth building. Leverage strategies offer the possibility of building wealth faster, but create the risk of losing wealth permanently. Conservative strategies offer slower wealth building, but protect against permanent loss. Most people choose based on temperament rather than analysis. Risk seekers choose leverage strategies. Risk avoiders choose conservative strategies. But the optimal choice depends on individual circumstances and long-term goals. For young investors with long time horizons and stable income, modest leverage might be appropriate. For older investors approaching retirement, leverage is usually inappropriate regardless of the apparent opportunities. The key insight is recognizing that leverage and safety are mutually exclusive. Strategies that can accelerate wealth building necessarily create risks that can destroy wealth building. The leverage paradox. The ultimate paradox of leverage is that it's most available when it's most dangerous and least available when it's safest. Richard had access to unlimited leverage during the 2000-2007 period because rising asset prices made lending appear safe to financial institutions. This availability made leverage seem safe to borrowers like Richard. But leverage was most dangerous during this period because asset prices were reaching unsustainable levels. The easy availability of leverage was a warning sign rather than a validation of its safety. During the 2008-2010 period, leverage was difficult to obtain because declining asset prices made lending appear dangerous. But this was actually when leverage would have been safer because asset prices were below long-term averages. This paradox means that relying on leverage availability as a signal of safety leads to exactly the wrong timing decisions. Leverage appears safest when it's most dangerous, and most dangerous when it's safest. The anti-leverage philosophy. Richard's story validates the anti-leverage philosophy that Charlie Munger and Warren Buffett have advocated throughout their careers. Their argument isn't that leverage never works, it's that leverage creates risks that outweigh its benefits for most investors. The Munger-Buffett approach prioritizes preserving wealth over accelerating wealth. They argue that intelligent investors should optimize for avoiding big losses rather than generating big gains. This philosophy recognizes that leverage makes big losses possible even for intelligent investors with sophisticated analysis. The mathematics of leverage mean that any strategy using significant borrowing will eventually encounter conditions where losses become catastrophic. Richard's story proves this philosophy correct. Despite his intelligence, analysis, and initial success, leverage ultimately destroyed his wealth when conditions changed in ways that his analysis hadn't anticipated. The eternal lesson. Richard's story will be repeated by future generations of intelligent investors who discover leverage and convince themselves that this time is different. The details will change. Different asset classes, different lending instruments, different market conditions, but the fundamental mathematics and psychology will remain constant. Leverage will continue attracting intelligent people who want to accelerate their wealth building. Some will succeed temporarily during favorable conditions. Most will eventually encounter adverse conditions that turn leverage from an asset into a liability. The market will continue teaching the same lesson. Borrowed money amplifies everything, and everything includes the mistakes that destroy wealth permanently. Richard was highly intelligent, but not intelligent enough to overcome the mathematics of leverage during adverse conditions. His sophisticated analysis couldn't change the fact that owing more money than your assets are worth creates bankruptcy, regardless of your intentions or expectations. The lesson isn't that leverage should never be used. The lesson is that leverage should only be used by people who can survive worst-case scenarios without bankruptcy. Most people, including most intelligent people, cannot survive worst-case leverage scenarios. Therefore, most people should avoid leverage entirely. Richard learned this lesson too late. His smart borrowing had made him broke. The mathematics had worked exactly as mathematics always work, precisely and without regard for intelligence, sophistication, or good intentions. Leverage had amplified Richard's intelligence during favorable conditions and amplified his mistakes during adverse conditions. The amplification was perfect in both directions. Richard discovered that perfect amplification includes perfect destruction when the conditions reverse. Smart borrowing became stupid lending when the cycle completed itself. The market collected another fortune from another genius who thought he understood risk better than risk understood him. Richard had been smart about everything except the thing that mattered most, recognizing that leverage makes temporary losses permanent when you run out of time and money simultaneously. That recognition came precisely when it was too late to matter. The leverage trap had claimed another brilliant victim who confused bull market success with eternal principles. The trap is perfect because it rewards intelligence until intelligence becomes irrelevant. Then it collects everything. every time, without exception. Richard's exception was that there are no exceptions. His intelligence was undeniable. His bankruptcy was inevitable. Leverage had made both possible.